Okay, so let's talk about corporations. The main thing we have to do is just kind of separate ourselves from our thoughts about what tax is always associated with individuals, because so far that's all we've really been studying. And so we have to instead say what parts of what we've already learned remain the same because it's just maybe a business tax law, and what parts are just of the things we have learned were just because that was individuals. And so we're going to be learning some stuff about corporations today. And then in later chapters, we'll be talking about other types of entities. We'll just briefly discuss some of the other entities today, but mainly we're trying to just shift our attention back toward, okay, we know some things about tax, but we're trying to figure out which parts to retain when it applies to corporations or other entities, and which parts are totally different for those new entities that we're going to be discussing. Okay, so we'll start with corporations. A corporation is just a taxable entity of its own right. It's like a person. So you can't just mingle personal assets with corporate assets. If you've had the business law courses, you've already learned about that, I'm sure, and the fact that you have to respect the corporate entity, and the fact that it's not just whoever owns the shares owns all the assets in the corporation. It has its own life, and its assets belong strictly to the corporation, and so we got to respect those lines. And then we also have to make sure we're recording the transactions in such a way that it can be traced, so that if there's some question by the Secretary of State about whether we are treating it as a legitimate organization of its own, then we'll be able to prove what we did. So just let me just 1 second. Sorry, I'm going to pause just for a second. Okay, so a corporation has to file a tax return and pay tax, and they use a form 1120 to do that. If a corporation is just a standard entity that is incorporated, then it's what you call a C corporation or a subchapter C corporation. So there are ways to shift the way an entity is taxed by doing elections, such as a subchapter S election. But if you don't do anything after you incorporate your business, then it's going to be a subchapter C or regular corporation, sometimes called a C corp. Okay, and so on that return, you would show all the company's business income plus expenses related to it to get to a taxable income number for the corporation. Then the corporation would have to pay tax. So currently, there's only one tax rate for corporations, which makes life easier. No need for all that complicated tax calc in these days, because we're just all dealing with a 21% tax rate. But the tax is computed on this form 1120 and then paid by the corporation, not by the shareholders. Okay, and so there's another factor about corporations is there's an unlimited number of shareholders, and that's why big companies that trade on the stock exchanges use C corps, because they can have unlimited numbers of investors then. And so if you see something trading on the NASDAQ or the New York Stock Exchange, you can be assured those are C corporations as a rule. Now, there are some ways to buy other entities, but the normal stocks that you see, like Microsoft or Intel or Tesla, those are C corporations that you're just buying a little piece of when you buy a share of their stock. Okay, and so another factor is the tax year for a corporation can be any month of the year. Usually, if you're trying to simplify the world, a lot of companies will just go ahead and coincide their tax year with the calendar year. And so they'll have a December 31st tax year end. But other companies and sometimes CPA firms like to choose a tax year for a corporation that is offset from the calendar year. So they'll pick a year like June 30th or May 31st or any month end actually, and use that as their year end. And the reasoning behind that is, one, for the CPA's perspective, if they're affecting the decision, maybe they're trying to split their workload and to where it's not all landing at the same time. Or if it's the company, they sometimes make it coincide with their natural business cycle so that it ends about the time of their peak season ends, so that you can kind of keep track of this is how our year went. based on how the company's cycle of revenue happens. So anyway, that in any case, they can choose whatever year they wish. And that's common to have a non-calendar year, which is called a fiscal year. And so large corporations, from the standpoint of whether they're going to use accrual or cash method, most corporations, especially those traded on the stock exchanges, use accrual basis of accounting for their tax return. Even though it's slightly different from financial accrual, it is still the accrual basis. And so large corporations have to use the accrual method. Smaller corporations, which is defined as gross receipts of less than 25 million, they can use either the cash or the accrual. But now if they have inventory, almost all of them are going to use the accrual because it's much more important. And also if they have large receivables, it's hard to keep track of the cash method because your records are all kept under the accrual method for financial purposes. So it's somewhat difficult to show your return on a cash basis if you are on accrual basis for reporting. So in any case, it is a possibility, though, for smaller corporations that they could be on the cash basis, or like we've talked about in some other chapters, they could be on the modified cash basis, and for financial purposes, that's like another comprehensive basis of accounting. But for our purposes, for tax, it is called the modified tax basis, where they would show, if they had small inventories, they would show that as inventory rather than as cash expense, of course. But those are just some of the things we've already talked about, cash and accrual, but it's just for corporations. Most of them are mandated to do, or most of the larger ones are mandated to do the accrual method. And then personal service corporations are in a category of their own. That would be like law firms, attorneys, law firms are attorneys, accounting firms or architectural firms, service companies. They have to use the cash method. And when there are multiple tax rates, they'd be taxed. Those same service companies would be taxed at the highest tax rate. So at this point, there's no tax rate disadvantage to having a personal service company be incorporated because they all are taxed at 20%. Okay, so now talking about the tax at 21% and the fact that the corporation pays tax. In a corporation that's not an S election, then a distribution to an owner would be considered a dividend. So that would mean that that money that goes to the owner is not taxed to them for Social Security purposes. It is just an income factor like interest income. So dividend income like you'd get from any other corporation. So even the owners would get dividends and they would pay tax on those, but they wouldn't owe self-employment tax, or Social Security wouldn't be withheld even though they were an owner. The only thing in a corporation that gets Social Security tax withheld from it would be wages or compensation. And so the trouble comes in a corporation in this thing that's known as double taxation. And it's a very common concept that a lot of people know is a problem for corporations. And that is where the corporation, when they pay out a dividend, cannot deduct it as an expense. So they're paying tax at the corporate level on the income that they distribute to the shareholder. And then when the shareholder gets the dividend, they have to pay tax on it too. So that is the double tax. The corporation paid tax on the profits, the taxable income, because dividends weren't deductible. And then the dividend, when it came out, was taxed again to the individual. So that's double taxation. And that's the part that causes some stress whenever you're the owner, especially when you have a small corporation and you only have one or two owners, and everything you make, you wind up distributing to the owners. Then that double taxation can bite pretty hard. Okay, now, so there is a slight compensation that's given to the owner of the shares, the shareholder, and that is this qualified dividend status. So when we talked about individuals, we talked about the fact that an individual that gives dividends would get a 1099-B that would show their dividend income, and then there would be a line or a box near that that would say qualified dividends. And that's just showing you what part of the total dividends are considered qualified. And that qualified dividend status gives the taxpayer favorable tax treatment similar to the cap gains rates. So they get a better tax rate on the part that's qualified dividends. So this is just like a little bone really that they throw to the individual to kind of mitigate some of this double taxation problem, because Congress realized that they were getting a double hit whenever they were getting dividends, and they were getting the corporation was having to pay tax too. And so they've given them a little benefit of a lower tax rate on the qualified part of their dividends. And so that helps. Now that's only for individuals. If a corporation owns shares and gets dividends from another corporation, they do not have the advantage of the qualified dividend, better capital gains type rates. But we'll talk about that again in a little bit. Okay, so if you're not a corporation, or if you don't want to be taxed as a corporation, sorry, if you are a corporation, but you don't want to be taxed as a corporation, you could do what's called an S election. And an S election is where you convert your C corporation into an S corporation by making an election on Form 2553, and it allows that entity now to be treated almost like a partnership. So it is taxed to the owners, whatever ownership share they have. There's a special election, and there's a limited number of shareholders that the corporation can have in order to qualify to elect as status. But we'll talk about this much more in another chapter. We have a whole chapter about S corporations later. But this is just another option of the way of what kind of entity you could be. If you don't want to continue operations as an individual, you could incorporate as a C corporation, or you could incorporate as a C corporation and do an S election. Or you could, here's the next one, be a partnership or a multiple member LLC. And so the partnership and the multiple member LLCs are also flow through entities, and they're taxed to the owners, but they are more of an informal organization. They don't start out as a corporation and then switch over to a pass through or a flow through entity. Instead, they start out just as an agreement between some parties that say, hey, we're going to go into business together, and they report their income jointly, so that becomes a partnership. Even if you don't have like a legal entity that's called the partnership ABC, then it could still be a real partnership and reported that way for IRS purposes. And so that would mean that I'm sorry, excuse me, one second. Sorry. Okay, so that would mean that each individual owner would show the net income from the organization's activities based on the percentage they own of the partnership. And so we'll talk about this one again. There's a whole chapter about partnerships as well that we'll deal with. Plus, we're going to, and we know already about sole proprietorships because we have had to learn a lot about sole proprietorships in the individual taxation class. And so the thing that's different about single member LLCs, LLC is a way to shield the owner from liability to a certain degree. But if it's a single member LLC, it's treated just like a sole proprietorship. So it would still show up as a Schedule C on their personal return if there's only one member of the LLC. If there's multiple members, it's treated like a partnership. So it's shown as on a 1065, and it flows through to each owner using a Schedule K at the partnership level, and then each individual owner would get a Schedule K1. And again, we'll have chapters where we talk about S corporations and partnerships, which are both flow through type entities, and we get way more detail at that point. But I just want to introduce this so that you know there's lots of different options about the entity that you can set up if you don't want to be a proprietorship anymore and you still want to continue your company. Okay, so here's some non-tax characteristics that would be considered when you're talking about a corporation. Some of the responsibilities for the liabilities are different. If you're an individual, no matter what the liability is related to, if your business gets sued, you are responsible for it 100%. That's if you're an individual or a sole proprietor. But if you are a limited liability company or a corporation, or what's called a limited liability partnership, which is still a form of a limited liability company, those would all restrict the liability the owner has, and that would be only then liable for the debts of the business and the direct actions they take those individual owners, rather than anything anybody in the organization did could be subject to a suit and you could be liable for what they did. But if you have one of these limited liability companies or a corporation, then the assets that could be attacked because of some kind of action of the business would be limited to those that are inside that organization, not the assets that are owned by the personal owners. So if you're a proprietorship, your liability is not limited to just the organization's assets, but you are also subject to your own personal assets could be attacked by some kind of, if they could prove some kind of that the business had been negligent. Okay, and then rights and responsibilities among the owners. No matter what your entity is that you have, each state has its own rules about what each owner has to do for if it's a partnership or if it's a corporation. So the legal responsibilities are handled by state law. So whatever state you operate your business in, you just need to make sure what the rules are for your type of business. And then when you look at the different types of organizations, only the C corporation has the ability to do an initial public offering and offer their shares for sale on a public exchange like the New York Stock Exchange, the NASDAQ, the American Stock Exchange. And so those C corporations, that's a strong pull for incorporating if you're trying to fund your business through issuance of stock. Okay, and then let's see, this next one, very deep subject, the transfer to a corporation. Doing that tax-free is considered a Code Section 351 transfer. So we're going to talk about this in depth, and then we're going to have some exercises in a separate video that explain how these different things work. And so this is probably the stickiest topic in this chapter for sure, maybe the stickiest topic in this course. So let me take just a pause, and then we'll come back and talk about this transfer, 351 transfers. Okay, transfers to the corporation that are not taxable to the individual or the corporation. That's a 351 transfer. Okay, so it's not a taxable event whenever an individual invests their assets in a corporation in exchange for stock, assuming these pieces are in place. One is that the only assets can be exchanged for the corporate shares in order to have no taxable event at all. And the second one is the assets, after the assets are transferred, the transferor has to include more than 80% of the corporate stock after the transfer. So even if it's multiples, as long as it's only stock, only assets that are transferring in, and the people transferring in have more than 80% of the shares at the end after the transfers, then there's no tax event involved. Now, if there are some other assets that are not considered assets, like if there's cash being transferred back to the investor, or if there's some assets that don't qualify for the official assets that can be contributed, then those would have to be taken into account. But and they would change the things. But in normal assets like buildings and equipment, different assets, the accounts receivable, any of those kinds of assets that are normal business assets that get put into a corporation, like if you have a sole proprietorship and you incorporate it, then those assets going in, as long as the person that transferred those assets in for their stock got a controlling interest in the corporation, then there's no taxability. And so that then what would happen if in that case where there's no taxability, the entity's basis would be the same as in the hands of the shareholder that just contributed. So that's called the carryover basis. And so whatever, if you had an asset that you had basis of $100,000 and you invested it into the corporation, even if the shares were worth $200,000, then your basis in those shares, assuming it was the 351 transfer and it worked, it was qualified, then the shares that the individual would get would carry over that same basis as the assets that they had. So the individual would still have basis of $100,000, and that entity that received the assets that were under a 351 a contribution to the corp would have the basis of the same as it was in the hands of their shareholder. So they would also hold those assets at a basis of $100,000. So the thing that changes is if there is gain. So that would mean that gain would have to be added to the entity's basis. And so so basically the entity's basis, to put it a different way, is the same as in the hands of the shareholder, plus any gain that had to be recognized on the sale. And so that's the carryover basis plus the gain that was taxed on the transaction. Then the shareholders' basis is the same as it was in the assets they just moved into the corporation, plus any gain they had to recognize on the transfer. So then what's left is the deferred gain is represented by the carryover basis. So in other words, you don't have the value of the assets being put in that you're considering. You don't have the value of the stock that's being exchanged. What you have is is the basis of the assets that went in, and then take that plus whatever gain has to be recognized. And so we'll do some exercises where we'll get more familiar with that. And when you flesh it out with the numbers, it does help. Textbook has some great examples of this also, but we'll work a few and then you'll get it as you start putting numbers to it. It does kind of get clear. Now there's this big exception. There's a couple of exceptions, but one of the biggest ones is when liabilities are transferred in with the assets. So I want to make sure I address this very clearly, hopefully. But basically, if you had this $100,000 asset that I was talking about, that your basis was $100,000 and it was worth $200,000, but you had a loan on the asset, and so maybe the loan was more than your basis. You had a $150,000 loan. The bank had loaned you because they knew the asset was worth more, so the loan on it exceeded the basis that you were holding that asset for. And so in that case, you could never transfer an asset in subject to a loan at an amount that would produce a negative basis. So you can't push it in at $100,000 with a $150,000 debt. You would have to bump your basis up to $150,000, which is the amount of the loan, so that you'd go into the corporation with your stock being with a basis of 0, because you are transferring in an asset, yes, but you're transferring a liability that cancels the value of that asset. So it's actually like you're selling the asset to the corporation in exchange for them taking over the debt of $150,000. So you would have a gain at the individual level of the difference between the $150,000 debt that was assumed by the corp and the $100,000 basis. So that extra $50,000 that the liabilities exceeded the basis would be a gain to the individual, and it would also step the basis up to the amount of the debt to get to a negative number. Hang on.